You're scrolling through real estate listings at midnight. Every single house that doesn't look like it's about to collapse costs $500,000. The kitchen has laminate countertops from 2003. The carpet is beige. And the listing agent calls it a starter home. Meanwhile, you're doing mental math on your salary, wondering if you've somehow missed a massive promotion or if the entire housing market has lost its mind. Spoiler alert, it's not you, it's the math. And the math is absolutely brutal. Today we're going to do something real estate agents hate. We're going to calculate who can actually afford a $500 house in 2026. Not who the bank will give a loan to, but who can legitimately afford it without turning their life into a financial stress simulator. Because there's a massive difference between qualifying for a mortgage and actually being able to sleep at night after you sign the paperwork. In dozens of US markets right now, $500,000 is the baseline. That's not getting you a mansion. That's getting you a 200 square foot box with 3 bedrooms, 2 bathrooms, and a yard the size of a beach towel. In cities like Denver, Austin, or anything within commuting distance of a major metro, $500,000 is what normal people are expected to somehow come up with for normal houses. The median household income in America is around $84,000, so we're asking people making $84,000 to afford homes that cost 6 times their annual income. If that ratio sounds insane to you, congratulations, you're paying attention. But everyone keeps saying you can do it. The mortgage broker says you're approved. Your parents bought a house on way less. Some influencer on TikTok is flipping houses with no money down. So what's the problem? The problem is that everyone is lying to you about what affordable actually means. And once you understand the real numbers, you'll never look at the housing market the same way again. Let's start with the down payment, because that's where most people's dreams go to die. The old rule was 20% down on a $500,000 house. That's $100,000 cash. Let me say that again. $100,000. The median savings account in America has around $8,000 in it. So you're not just a little short, you're $92,000 short. And before you say you'll just save it, let's do that math too. If you're making $84,000 a year and somehow manage to save 10% of your gross income, which almost nobody does, you're saving $400 per year. At that rate, it'll take you 12 years to save the down payment, assuming housing prices don't go up, which they absolutely will. So you skip the 20% down payment. You put down 5% or 10% instead, which is what most people actually do. Congratulations. You just unlocked a new expense called PMI, private mortgage insurance. This is the fee you pay every single month for the crime of not being wealthy enough to put 20% down. It's a poverty tax that runs anywhere from $200 to $400 per month. You're paying extra money every month for insurance that protects the bank, not you, because they're worried you might default. So you're already starting from a position of financial punishment before you even move in. Now let's talk about the actual mortgage payment. You put down 10%, which is $50,000 that you somehow scrape together. That leaves you with a $450,000 loan. At current interest rates somewhere in the 6% to 7% range, your monthly mortgage payment is going to land around $2,750 to $2,850. That's just principal and interest. That number doesn't include a single other thing you need to actually live in the house. Let's add property taxes. Depending on where you live, you're looking at anywhere from $4,000 to $8,000 per year, which works out to roughly $500 per month. Then there's homeowners insurance, which has skyrocketed thanks to climate change making everything more expensive to insure. You're looking at another $250 to $350 per month. Then there's maintenance, the thing everyone forgets about until the water heater explodes at 11 p.m. on a Sunday. The general rule is to budget 1% of your home's value per year for maintenance and repairs. On a $500,000 house, that's $5,000 annually, or about $417 per month. And don't forget the PMI we talked about earlier. Tack on another $200 to $400. So let's add this up. Mortgage payment, $850. Property taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Your total monthly housing cost is now sitting at roughly $4,367. And that's assuming nothing breaks. You don't need a new roof. Your HOA doesn't randomly decide to repave the entire neighborhood and send you a $3,000 bill. This is the number that changes everything. Here's where it gets really interesting. Financial advisors will tell you that you shouldn't spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio is under 43%. Let's reverse engineer this. If you're spending $4,364 per month on housing, and that represents 28% of your income, you need to be making roughly $187,000 per year. If we use the more lenient 43% rule, you still need to be pulling in around $150,000 annually. And now we arrive at the punchline. Only about 10% to 20% of US households make $150,000 or more, which means 80% of American households cannot comfortably afford a $500,000 house under any reasonable financial standard. This isn't an opinion. This is just math being cruel. But you're thinking, people are still buying these houses. Who are these people? Some of them have dual incomes in high-paying fields. Some of them have family money. Some of them are stretching themselves so thin that one medical bill or job loss would collapse their entire financial life. Let me show you what that actually looks like when you run the numbers on a real household trying to make this work. Meet a household we'll call the Johnsons. Two working professionals pulling in a combined $160,000 a year. That puts them well above the median, solidly in the upper middle class. They should be comfortable, right? Let's watch what happens when they buy that $500,000 house. Their gross income of $160,000 sounds impressive until the IRS shows up. After federal taxes, state taxes, FICA, and a modest 401k contribution, they're taking home around $9,500 per month. That's their actual money to live on. Now subtract that $4,367 monthly housing cost. They're left with $5,133 for literally everything else in their lives. 2 car payments, because they both need to commute. There goes $800. Car insurance for 2 vehicles, another $250. Gas, $300. Student loans, $600. Health insurance premiums their employers don't fully cover, $400. Groceries for a family trying to eat reasonably healthy, $800 if they're careful. Utilities, $450. They're now at $533 remaining. And they haven't touched clothing, entertainment, kids' activities, car repairs, medical copays, or the psychological need to occasionally leave the house and pretend you have a life. Oh, and savings. Emergency fund. Retirement beyond that modest 401k, good luck. This household is spending 46% of their take-home pay on housing. Not 28%, not even 35%. Nearly half. And these aren't irresponsible people. They're not buying jet skis or taking European vacations. They're just trying to live in a house that the market tells them is normal. Here's what that actually feels like day to day. It feels like checking your bank account before buying groceries. It feels like saying no to your kid's field trip, because that $35 might be needed if the check engine light comes on. It feels like lying awake at 2 a.m. doing mental math about whether you can afford new tires this month, or if you need to push it to next month and just pray it doesn't rain. It feels like being one unexpected expense away from disaster at all times. The HVAC breaks. That's $5 or $1 you don't have. Someone rear-ends you and your deductible is $1. You're putting it on a credit card. Your kid needs braces. You're financing dental work like it's a car. This is the reality for households earning $160,000, trying to own a $500,000 home. Now imagine what it looks like for the household making $120, dollars or $100, dollars or, God forbid, the actual median income of $84,000. At median income, buying a $500 house isn't tight. It's not even stretching. It's financial fantasy. It's mathematically impossible, without either massive external help or accepting a level of risk that would make a skydiver nervous. But here's what makes this truly insidious. The housing market doesn't care about these numbers. Sellers list homes at $500, $1,000 because that's what comparable houses sold for. Banks approve buyers at 43% debt to income because technically the loan won't default immediately. Real estate agents encourage buyers to stretch because their commission depends on closing the deal. Nobody in the transaction has an incentive to tell you that you're about to financially drown yourself. The system is designed to get you into the house, not to ensure you can comfortably afford it long term. And once you're in, once you've signed those papers and moved your furniture, you're trapped. You can't just decide 6 months later that this was a mistake and walk away without destroying your credit and losing your down payment. So people stay. They stay in homes they can't afford, working jobs they hate because they can't risk any income disruption, slowly watching their savings evaporate, wondering why they feel so stressed when they're supposedly living the American dream. For probably 70% to 80% of American households, a $500 down home is not affordable, not sustainably, not without accepting a level of financial precariousness that would have previous generations running for the hills. The harsh truth is this: the housing market isn't broken. It's working exactly as designed. It's designed to extract maximum wealth from people who can't afford it. It's designed to make you feel like you're failing when you're actually just facing an impossible equation. And the cruelest part? Everyone around you is pretending the equation makes sense. Your realtor, your mortgage broker, the market. They're all pretending that $500 is normal, that you should be able to afford it, that if you can't, it's because you're not trying hard enough. But the math doesn't lie. And the math says that for most Americans, this version of the American dream is a financial trap disguised as an opportunity. The question isn't whether you can afford a $500 house. The question is whether you're willing to sacrifice your entire financial life to buy one. And if you're not failing. You're just being honest about the numbers, and that honesty might be the smartest financial decision you ever make.